Happy New Year's. I hope your holidays were great, however you chose to spend them, and welcome to the very first San Diego Market Matters of the year. This is the episode where we reset. We're going to zoom out. We're going to get grounded in what actually happened in the housing market. Not the headlines, not the hot takes, and definitely not the doomsday noise. Because if you want to understand where this market may be heading next, you have to start where it just came from. Now, here's the interesting part. Based on everything you're hearing online, this market should be falling apart right now. We got higher unemployment, inclining inflation, rates that never really got significantly cheaper, but here's the problem. That's not what the data is actually showing us. Inventory is up, buyer applications are up, prices are still growing in most major metros, and yet homes aren't flying off the shelf. So today we're breaking down why this market isn't crashing, why it isn't booming either, and what's really happening underneath the surface. Because if you're buying, selling, or just trying to make sense of 2026, this context matters more than any prediction out there right now. All this national data and more covered in this week's San Diego Market Matters. I'm Karl, your San Diego realtor. If you haven't liked and subscribed to the channel yet, consider giving it a shot. This way you can stay up to date on the San Diego market. Now, let's jump into this. We've got unemployment creeping higher, now sitting in the mid 4% range. At the same time, PCE inflation has ticked up as well, which tells us price pressure hasn't fully gone away. Normally, that combo would point to a slowing economy. But here's the curveball. GDP is still growing over 4% in the most recent quarter. And that doesn't happen by accident. A big chunk of that growth is driven by the AI and tech sector, where a massive amount of capital is being recycled among a relatively small group of companies. In other words, the economy looks strong on paper, but that strength isn't evenly distributed. And that's why a lot of people don't feel like we're in a booming economy, even though the headlines say we are. Now let's connect that with the housing market. Mortgage rates have been hovering around the low 6% range for a 30-year conventional. Not cheap, but importantly, stable. And if you look at the alternative products, the picture changes. The 7/6 ARM, FHA, or VA loans put you below 6% right now. And I'll say it plainly. I personally think the 7/6 ARM is one of the smartest products on the table right now. You're locking in a lower rate for 7 years in a market where most people aren't staying in the same loan for more than 3 to 5 years anyways. That's not gambling, that's more of a strategic or structural move. Now with FHA specifically, there may also be a potential tax benefit tied to mortgage insurance under the new tax framework. We're still waiting for final confirmation there, but it's something worth watching closely. It's supposed to be permanently deductible starting in 2026. What's important here is this. With the most recent Fed cut on December 10th, this was one of the first times where you've actually saw mortgage rates move lower after the announcement. That hasn't been the norm over the past few years. But here's the reality check, and this is the part most headlines are skipping. The problem isn't interest rates, it's that even slightly cheaper money is still buying very expensive payments. Affordability is still the gatekeeper here, but there is some good news on the horizon. There are reports out there that income growth is growing, which is exactly what we need. We want price to stay flat, maybe lower a little, and then allow incomes to catch up. Market certainty definitely matters. Buyers want clarity, but affordability is what's stopping people from moving right now. Lower rates don't automatically fix that when insurance, taxes, and everyday living costs are still super elevated. And that's why this market isn't frozen. It's just really constrained. Constrained by affordability and slowed by uncertainty. The buyers who are moving forward right now aren't waiting for perfect conditions. They're using smart structures, focusing on payments and staying flexible instead of trying to time a headline. Now, moving on to the national inventory, here's what the headlines aren't telling you. Yes, national inventory is up about 13% year over year. That sounds dramatic until you look at where the inventory actually is coming from. A disproportionate share of the new supply is concentrated in a handful of states, specifically Texas and Florida, and that distinction matters more than the headlines number themselves. If we look at new listing inventory, these are the number of homes coming to market for sale. We had a slightly less number of homes come to market in the month of December in 2025 than we did in 2024. That tells us that inventory not grow as much, and we have less new homes contributing to the already present standing inventory, aka lower supply. Now, check this out. When you look at the map showing metro areas with year-over-year declines, those red clusters line up almost perfectly with where inventory is surged the most. Texas and Florida stand out immediately, and those are markets that aggressively overbuilt or saw demand cool faster than supply could adjust to. That's not coincidence. When inventory grows faster than demand from buyers, prices soften. That's basic market math, or Econ 101. Now contrast that with the map showing markets still experiencing price growth. Most of the country is actually still in that category. The Midwest, parts of the Northeast, and even select West Coast metros are holding on to positive year-over-year appreciation, largely because their inventory growth has been more controlled and demand hasn't collapsed. Here is your takeaway from all of this. All the YouTube economic doomsayers were wrong. There was no crash in 2025, obviously. These doomsayers, they're not economists, they are entertainers. Nothing more than that. Interestingly, San Diego technically shows up on the national decline map at roughly 1.5% dip year over year. But when you compare that to our local MLS data, the story changes. It's not to say that data is wrong, but rather that the data is measured differently depending on the source. Inventory here has not exploded the way it has in Texas or Florida. Buyer absorption remains steady, and pricing behavior locally has been far more resilient than the national map would suggest. This is exactly why I always say real estate is hyper-local. National data sets the backdrop, but local conditions write the script. And if you want the full breakdown of what's actually happening here in San Diego, make sure you are subscribed, because next week we're going to do a deep dive into the December local data, and it tells a very different story than what we're seeing nationally. Now let's build on that and talk about buyer behavior, because this is where the story gets really interesting. We're seeing dynamics in the data that it just doesn't line up at all with the narrative that the market is falling apart. Now, we just established that inventory is higher than last year, and mortgage rates have slowly drifted back into the low sixes. So naturally, you'd expect activity to pick up across the board, and in some ways it has. If we look at mortgage purchase applications, buyers are clearly coming back to the market. Applications in 2025 are meaningfully higher than they were in 2024, which tells us something important. People aren't sitting on the sidelines because they're scared. They're re-engaging because buying feels possible again as rates ease. That alone pokes a pretty big hole at the idea that demand has completely been wiped out or disappeared. But here's the disconnect. Even with more inventory and more buyers applying for mortgages, total pending home sales in 2025 were basically tracking right alongside 2024. They're not surging, they're not collapsing either. They're flat. And that gap between interest and action is the story of this market. And this is where that national price growth map we looked at earlier really clicks. Even with hesitation, most major metros are still seeing year-over-year price growth. That tells us the demand hasn't vanished. It's gone selective. Buyers are engaging, but they're only pulling the trigger when the value, the condition, the payment makes sense for them. This tells us that affordability is still the governor on the engine. Buyers are active, but they're selective, and honestly, they should be. They're saying things like,
I can buy, just not at that price for that house or with that payment.
Today, buyers are being extremely conscious of what they're getting in exchange for a monthly mortgage payment. The days of buying mediocre homes at top of market pricing is largely gone. And this is where the price reduction data really matters. Price cuts dropped sharply in December. If buyers were leaving the market or confidence was breaking down, we'd see the opposite. Instead, sellers adjusted earlier in the year. Buyers who could make the numbers work stepped in, and the market found a temporary balance. That's not a market rolling over, that's a market filtering. So when you zoom out, what we're really looking at is more friction, not failure. More supply, more buyers, fewer forced decisions. Homes are still selling, just not automatically and not the way over list price in most cases. And until affordability improves or incomes meaningfully rise, buyers are going to stay picky, which keeps the market stable, but very selective. So when you take all of this together, inventory higher, buyers back, pendings holding steady, and prices still growing in most major metros, the takeaway is pretty simple. The national market isn't breaking yet. It's recalibrating, and affordability is the filter that's deciding who actually moves forward and who doesn't. All of this is the national backdrop, but as we've already talked about, real estate doesn't live in national averages. It lives locally, and San Diego plays by its own rules. Next week, once the December San Diego data drops, we're going to put this national story side by side with what's actually happening here on the ground. inventory, pricing, days on market, and buyer behavior, because the local picture tells us a very different story than the headlines would have us believe. And that's a wrap. I hope this data update was valuable and helpful for you to get a better pulse of what the market is doing nationally. Be sure to like and subscribe if you haven't already. As always, I'm Karl Kyler, your San Diego realtor. We'll see you in the next video.